Okay, hi everyone. Thanks for joining me today for a market update during COVID-19. We're going to talk about what's happening in the market in light of the current situation, what are the prices doing, as well as some of the changes this pandemic is bringing to the market and to our lives. A little bit about myself. This is my sixth year in real estate. Before real estate, I was trading mortgage bonds that were backed by the homes I sell today. I remember I just got on the trading floor in early 2007 and the market imploded. Um, and then in 2014, I left finance and started in real estate. And I've been here since. It's been a great journey. All right, let's get right into it. How is the market? What is happening right now? Not a whole lot. The market has not seen a lot of new contracts signed since the lockdown, a little over 6 weeks ago now. Um, Even those contracts were signed by buyers who had seen the properties before, and then now they're coming back to negotiate a better deal. Take myself as an example. I negotiated a handful of deals in the last 6 weeks. Um, all my so in those transactions, I represented all buyers. All my sellers are off market at the moment. So for my buyers, half of those deals, the sellers wouldn't come down to meet our levels, and then on two of them, we actually had accepted offers, but then the buyers eventually decided against moving forward. You know, to them, they even with these large discounts, they weren't 100% comfortable in the end. There's one deal that is going to move forward, and it's actually the largest of the a couple of deals. And in this case, the buyer is convinced and strongly believes, and I believe that she's getting a great deal. You know, so now at the moment for transactions to happen, sellers need to take a sizable discount. The question is whether these discounts will persist or how long they will persist once we reopen. Now, there's no question in my mind that prices are definitely going to be lower or lower already. Um, the question is what's going to really happen. The market is, undeniably under a lot of pressure. We have the recession, we have unemployment, and the foreign buyers who can't make the trip right now. And on top of that, banks are tightening their underwriting guidelines. Before, so on top of the 20%, a 10 to 20% down payment plus the closing cost, uh, you didn't need anything else. But now the banks are requiring anywhere between 6 months to 12 months of carry cost. So basically, your mortgage payment, the principal and interest, plus maintenance, plus taxes. So that number, 6 times or 12 times that number, needs to be set aside on top of the down payment and closing costs. So the upfront cost requirement is higher for borrowers now. And I'm also hearing a lot of the commitment letters that were issued before the crisis are being rescinded for this reason and some other reasons. So the market is definitely under a lot of pressure. But in the meantime, I also don't think the prices are going to go into free fall. Um, the single biggest reason is going to be inventory. So since the lockdown started in mid-March, more than 1,000 of listings have come off the market. And in April, so far, I think we're only seeing a couple hundred of new listings. April is traditionally a big month. We usually see around 2,000 new listings hit the market just in Manhattan alone. So again, this month we're seeing just a few. Um, and this is sort of what happened in 2008 during the crisis when our market, the New York City real estate market went down 25%, while the national market went down 50. That's sort of what happened back then. Is New Yorkers tend to have a pretty strong hand. So when goings get tough, they hunker down. Right? They just don't sell. Just to quote some other people's numbers, B of A is calling for home prices to decline um, by 2.5%, roughly 2.5% in April next year. April 2021, they don't think, and the reason is they don't think there's going to be a large wave of foreclosure, which was what happened in 2008 in the housing-led recession and was what seriously damaged the housing market. In this case, they didn't think so. Now, obviously, this predicated upon the fact that unemployment so far is largely concentrated in small business. Corporate jobs have largely been safe. So we'll see. I mean, this has to continue for that prediction to come true. And on a broader side, they also are calling for the broad economic output to contract by 10% this year. And there's another thing. There's another thing to remember is our particular real estate market peaked in 2015. So we have decoupled from the broader market for the few 3-4 years now because we were oversupplied. So we had our own problems, and we've had a few years to work through our own problems, and we're starting to get healthy. At the end of last year, starting with last October to this February, I felt it, and a lot of my colleagues felt it. You know, we had more buyers pull the trigger, people who had been on the sidelines for a while. And I remember seeing number of listings that went into contract in this January 2020. That number was twice as many as January 2019, a year ago, and it was still more than 2 years ago in January 18, almost the same level as 3 years ago in January 2017. So the market was starting to gain its footing towards the end of last year before the whole crisis hit. Activity levels of activities went up. Prices had not improved, but we were starting to see transaction levels go up. And so here you have it. You have the crisis as the background, and our particular market was starting to get healthy, but now we have the external shock again. So we'll have to see. Once we reopen, all these discounts, will they persist, go bigger discounts, or become smaller? One of the area during this whole time that I've been home, I've been talking to a lot of my colleagues on the commercial side as well, residential side. It's been fascinating to me that in terms of changes that this pandemic is going to bring to our lives. And for one, I feel people are nicer now. Before I couldn't get managing agents, people who manage buildings, people who approve purchase and rental applications for me. I couldn't get them to pick up my calls ever. A couple of days ago, I had one managing agent graciously agreeing to stop payment on a check that was sent to my company, where we haven't been able to collect mail. So he agreed to stop payment and reissue one to my home address. And the whole exchange was very pleasant now, with greetings and well wishes, all completely unthinkable in the past. The big question in terms of changes, the big question is really, and I'm getting asked a lot these days, is are people going to pack up and leave New York? Because things that make New York City so desirable, our shows and museums, they're probably not coming back for a little while. And then now, as companies and workers are getting more comfortable with working from home, and if after we reopen, people can work at least one day from home, then it lessens the pain in the commute. And if that's the case, maybe more people will consider moving to the suburbs. So, and I think these are very valid reasons. And I do think we'll probably lose some people, just like when they first passed the SALT new tax laws. New York City experienced negative population growth, I think we'll probably see the same here this time around. People who were on the verge were thinking about it. This is a good catalyst for them to finally make the move. Um, yeah, I love living in the city is because and I really don't go out that much. I like living here because of its convenience and because the energy I get from its people. So I think it's important for New York City to be able to retain the diversity of the people that it attracts and people who come here to live here. When young people used to say, or maybe they probably still say, New York is where I want to live, before I settle down somewhere. This needs to continue to hold true for New York City to continue to be the destination for young minds and creative minds. Everyone wants to make something out of themselves to come here. And I think the efficiency and economy of scale of urban living are not going away. It's probably finally time that we don't have to wait for 3 trains to go by to finally get on the fourth one. Changes are they're painful, but they're probably for the better. Speaking of changes, the on the commercial side, so through this whole thing, commercial real estate has been hurt more than residential. People still need a place to live, and commercial is more related to broader economic activities. Um, so on the office space, in the office space, people are foreseeing a lot of changes. Office tenants are probably going to want less space, but better space equipped with better technology to connect the remote workers, and also spaces that provide greater flexibility that allow for different configurations when people do get together. So for different occasions, work occasions, these spaces need to be able to accommodate different needs. Let's talk about the rental market really quick. I manage quite a few investor properties for my overseas landlords, and we were really worried at the end of March. We didn't know if we were going to collect April rent, and thankfully, I am truly very thankful that all of our tenants, the tenants that we manage, paid April rent. And data shows 70% of New York renters paid at least some of the April rent. And there's a recent survey of renters that were going to move in the second quarter. 70% of these tenants still plan on moving in July and August, hopefully when we reopen. And so I think the residential rental market is going to do largely okay. We may see rents come down. Again, the rental market coming into this crisis, the rental market was very strong at the beginning of the year. Because I do help a lot of the international students rent their apartments. And the season usually starts in late March. And this year we're seeing it in February. We were already seeing a lot of demand from students, international students. So we'll see. Again, this whole thing now is it's all from ground zero, right? We'll see coming out of this how everything is going to be. But I do think the rental market is going to be relatively okay. All right, so that was some thoughts on what's happening in the market in light of COVID-19. Let's dive a little deeper into inventory. Because inventory is the ultimate driving force that shapes the direction of any market. Now, on this prior slide, I put inventory both as a negative market force and a positive market force. That's because we have oversupply in new construction, but not so much inventory, especially good inventory in resale. This chart here shows months of supply as a way to measure inventory by property type. Months of supply basically means if we assume the current pace of market, how many months does it take to sell out all the existing for sale listings? The burgundy line that hovers over everyone is townhouses. The townhouse market has been so oversupplied, it takes an average townhouse 1.5 years to sell. But there have been some chatters with the health crisis. Maybe the townhouse market will finally see an uptick in interest as people want to be more private. But we'll see. Now let's focus on the light blue line here. The light blue line is inventory in new construction. We can see that the blue line peaked throughout 2014 and for the first half of 2015. So we had a huge surge in new construction inventory then. And this is really what caused the market to peak in late 2015 and then started to decline really since then up till now. Towards the end of last year, we started again see the trend to turn for the better, but prices have not really recovered. So for the residential market to really see a recovery in prices, we need this blue line to really change direction. The handful of deals that I negotiated in the last 6 weeks that I mentioned earlier, they were without an exception in new construction. So the sponsors of new construction projects are definitely showing more room for negotiation versus the resale sellers, because they do have, versus just a private seller, they have more apartments to go and they have construction loans and they have lenders to work with. So they are under real timeline. Okay, so let's talk about some other interesting things for the real estate market. We're going to show you the dollar per square foot, which is, to me, one of the most important metrics to see how expensive, how do you value an apartment. So we're going to show people dollar per square foot for different neighborhoods in Manhattan and how they are performing versus each other. And first up, how much is an interesting question. How much do you think an average apartment in Manhattan appreciated per year since year 2010? Now we know from 2015 to now, it's been a depreciation every year. But if you had bought it in 2010 and then to now, from 10 to 15, it was a one-way street up. Coming out of the 2008 recession, every year was a huge appreciation. So from then to now, what is the average annual appreciation? Now this chart shows a proxy to that metric. It's not exactly to say, okay, I bought an apartment in 2010. If I had sold it this year, how much appreciation would I see? This chart shows the annual growth rate in median sales price for Manhattan. So it's not the same apartment, it's just a median sales price. So this chart here skews the numbers to the higher end. The conventional wisdom says actually I've done the same calculation for as far back, if we started counting in 1997, we still see this number hover around 4% for Manhattan. So the conventional wisdom is for residential real estate to appreciate average 4%, around 4% a year. Here this chart says 4.6% for Manhattan and 5.7% for Brooklyn. These numbers are a little higher because recent years we've had more high-priced new construction units that closed. Another interesting thing on this chart is Brooklyn has done better than Manhattan in the last decade. That's because the last 10 years was really Brooklyn's renaissance. People's perception of Brooklyn has 100% completely changed. The decline, for instance, we witnessed in Manhattan since 2015, we really didn't see that much decline in Brooklyn. Every month, the new inventory to hit the market in Brooklyn has always been a lot less than Manhattan. All right, so let's get to the interesting chart. This is a median dollar per square foot for some select neighborhoods. We see here West Village is the most expensive neighborhood here. Tribeca is up there. The well-known neighborhoods, the Upper West Side, Chelsea, Flatiron, they're all up there. I bet some of you in the audience didn't even know there was a neighborhood called Two Bridge in Manhattan. That is a small neighborhood between the Brooklyn and Manhattan Bridge in Lower Manhattan, next to Chinatown. And this very crazy dollar per square foot number is basically attributable to one single new construction project related. Um, their new project called Manhattan Square. But Two Bridget it is really Lower East Side 5 years ago. This is one neighborhood, in my opinion, that begs some attention. Here, we try to show some relative performance. So there are two bars. The blue bar shows the price change from last month, and the yellow bar shows the price change from last year. If you see both bars going up in the positive territory, that means the neighborhoods are doing well. If both bars are going down, that means, at least for the periods we're looking at, these neighborhoods are not performing as well. And one interesting thing that comes out of this chart is the more established neighborhoods, such as West Village, Upper West Side, Chelsea, they just keep going up despite their high prices to begin with. We see also here Sutton Place is also doing well. Sutton Place is not that well known, and in my humble opinion, it's also one of the neighborhoods that's undervalued. It's a piece of gem because it's tucked away in a quiet part of Midtown, but it's very walkable to cross on trains. You have pretty easy train options. Another neighborhood I want to mention briefly is Battery Park City here. Battery Park City is also doing well. It is a interesting neighborhood. It's a tough sell usually to newcomers to BPC, to Battery Park City, because its nature as a land lease area. Most of the buildings are on land lease, but it's such a wonderful place to live. It's very green. It's on the river. So a lot of the transactions in BPC are among the long-term BPC residents. All right, so we talked about the market in light of COVID-19, and then we covered some of the mostly asked questions in terms of real estate as an investment. How much do apartments really appreciate? And what about the different neighborhoods, how they do versus each other? Thank you very much for joining me. If you have questions, feel free to reach out to me. Thank you very much.